Hi everyone, let's cover my Elliott Wave analysis on Bitcoin on the weekly, 4-hour and the 1-hour time frame. And on the weekly time frame, we're still looking for new all-time highs. We're looking for 4 and then a final wave 5 towards the upside to end the bull market. Now for this wave 4, I have 3 main areas of support, 107.7k, which is touched, 105 and 96. If this is the low of wave 4, then this move towards the upside has to be a motive wave structure, so either an impulsive move on the lower time frame, 1, 2, 3, 4, 5, correction, look for continuation, or a diagonal structure. And that is something I'll cover in a second on the 4-hour time frame. And then we have wave 5 to the upside, which by itself should be a larger 5-wave structure. And once wave 5 is finished, the bull market would end and we're starting the bear market. But then we go to the 4-hour time frame. And on the 4-hour time frame, the scenario that continues this range for a longer period of time, so you create a larger wave 4 on a weekly time frame, is what you see on my chart. So here we are looking for a larger 3-wave corrective structure, after which we then look for that wave 5 to the upside. Now what you see on my chart at the moment is a WXY double zigzag. So we have an ABC in a wave W, we look for a larger corrective structure in a wave X, and another ABC down in a wave Y. In this scenario, you want wave Y to move below wave W, which means that the 2 support areas that are not yet touched on the weekly time frame become important, 105k and 96k. Now after wave Y, you then want to see that wave 5 to the upside. Now if we look at wave X in a little bit more detail, then we start with an ABC zigzag to the upside with a triangle inside wave B, wave W finished, looking for a wave X retracement. Preferably, wave X retraces to at least the 0.382 Fibonacci at 113.1k, and preferably wave X is finishing at least after this vertical line, sitting on the 17th of September, 2 a.m. Central European Time. However, for a double zigzag WXY inside X, hopefully it's not getting too complicated now. So as you can see, we have the larger WXY double zigzag, but inside wave X, we oftentimes also see a zigzag family structure. And at the moment, we would then also count another double zigzag, but then to the upside. So we have then a WXY double zigzag to the upside inside wave X. And preferably this wave X here, this retracement, is not going to touch the 0.7 Fibonacci at 110.1k, as that reduces probabilities for a double zigzag. If price would move to the downside and touch the 0.7, then the probabilities increase for more sideways corrective structures inside wave X. And the reason why I'm looking for a larger corrective structure here is actually because of this range, which is a higher probability corrective structure on the 1-hour time frame. So therefore, probabilities are low that wave X is already finished here, and you are already looking for a wave Y to the downside. Finish Y and then move up. I'll show that in a second once I cover the 1-hour time frame. Now you can see that here for this wave X, I have a bit of an area of interest, or not necessarily an area of interest, but basically target areas for different scenarios. So this wave Y in a WXY would finish above wave W. Preferably though, it doesn't move beyond the 0.7 at 119.3k. So that means your target area for your wave Y is basically between 116.8k and 119.3k. Now if price moves beyond the 0.7 and you get into this box over here, between 119.3 and 122.8, the probabilities increase for a double 3, which is a sideways WXY. So you get your W, you then get a wave X, and then you get a wave Y and you move towards the upside. Wave Y in this scenario does not need to take out the low of W. While if you're looking for a double zigzag WXY, you really like to see wave Y take out the low of W. So that's a big difference. Now if price moves even further and moves to 122.8k or beyond 122.8k, then we're moving into flat territory, and that's when flats have higher probabilities. So then you're looking for your wave A's, your wave B's, wave C, and then continuation to the upside. So basically, depending on how price moves, how high price is moving in this area, probabilities are switching between scenarios. Double zigzag, highest probability, double 3, highest probability, flat, highest probability. We just got to wait and see what we get. And then we have the bullish scenario. And the bullish scenario would mean that potentially your wave 4 is finished here. And you look for price to continue towards the upside in a 1, 2, 3, 4, 5. Bull market continues to look for a wave 5. However, you can see that I also labeled this a wave A, because this impulse to the upside can be wave A. You get a wave B to the downside. You move up in a wave C, which is mimicking a potential continuation of the bull market for a larger wave 5. However, after your wave C, you move back down, which would create a flat structure in that case. So you would have your first move down, which is then wave A of a flat. You get a 3-wave structure, that's your B, and then you move down in a wave C. Alternatively, again, you would create a more sideways, like you have your W, your X is a simple zigzag, and you get a wave Y. So in other words, a larger corrective structure. Nonetheless, though, for the bulls, this is an important scenario because they need this scenario in order to have the opportunity of wave 4 being in at the low and looking for a 5 up. If this is not what they get, it becomes very difficult because counting a multi 1, 2 here, 1, 2, 1, 2, 3, it's not great counting like this whole structure as a single wave 2 here because it looks very triangle-ish, right? And a triangle is not allowed in a wave 2, so not ideal. So preferably for the bulls, we would actually see a couple more 4, 5. So you have your move up, there's a couple of 1, 2s in this range. In this particular scenario, you just need to have a couple of 1, 2s in there. You get your 3 to the upside, and then you get a couple of wave 4s and 5s to the upside. Now, after your wave 4s and 5s, you finish 1 or A, you look for a retracement to the downside, where this becomes very interesting support, by the way, between 112.9K and 109.8K. And then you're looking for price to move towards the upside once more. And then the minimum target is taking out this high, that's target 1. And then depending on how the structure is evolving, you might look for all-time highs. And then you got to be aware of wave 3 or wave C. Now we'll see, no pun intended, but we'll see what happens if we get there, right? I mean, let's first wait for the 4s and the 5s because it's actually still quite early to really count this impulse here and give it the highest probabilities, which is the reason why I can't, because we don't have enough information here with 4 5s to make up for the potential amount of 1 2s that we would then have over here, because I don't like to count it as a single wave 2 here, because I can't get, unless it's a triangle, I can't get another nice wave 2 structure in here. And a triangle is not allowed, as mentioned, in a wave 2. But it is allowed in a wave B, but that supports a more bearish scenario, being a larger structure for a larger wave 4 on the weekly time frame. And then we get to the 1 hour time frame. And over the weekend, price was forming this range here, and the probabilities were quite clearly higher for this move down to be a corrective structure, which means that sooner or later you expect price to take out this high. That's the bias on the 1 hour time frame. However, you can still move in larger corrective structures. Let me explain. So first of all, why are the probabilities highest to take out this high? Well, I'm glad you asked. So here price moved towards the downside. However, quite clearly, this move down looks like a 3-wave structure. And what's important is it touched the 1.618, which is taken from this low to the high. And that's a very important detail because price touched the 1.618, meaning a flat A, B, and then a wave C up has low probabilities. And that is important for the probabilities of the overall structure to the downside, because if this could be a flat, you could have a move down, sideways, and then get a C or 3 to the downside, for example, right? When we touch the 1.618, lowers probabilities for wave B of a flat, increasing probabilities that if price moves back up, that this is a 3-wave structure. Cool. Then price moved back up, touched the 886, taken from this high to this low, which also minimizes probabilities for a double 1-2, 1-2, 1-2, get a wave 3 down, which then by itself increases the probabilities that this range is corrective, because we can't really count a bearish structure anymore, being an impulse, 1, 2, 3, 4, 5, there's no impulse here, multi 1, 2, lower probabilities, and a diagonal, not possible, because we have 1 low, 2 low, you need another one. We didn't get another one, right? You wanted to actually see something like this, but we didn't get it. So the probabilities are higher that this structure to the downside is a WXY. However, a WXY structure can still be part of a larger corrective structure like a flat ABC. You can also still have this as a W, A, B, C, that's your X, and now you're looking for a wave Y to the downside, which still is a larger corrective structure. But after Y, you look for price to move up and take out the high. Now price also here touched the 886, taken from this high to this low, which increases the probabilities to still take out this high. And it is very common at an 886 to see a reaction and a retracement, and then at a later stage you go back up to take out the high. So there's many different reasons why the probabilities locally are higher to still see this high taken. And when we consider some interesting support and resistance, then as the probabilities were higher that this is corrective, the areas of support to the downside become very interesting. We touched the daily naked point of control to the absolute T here at 114.9K. Beautiful touch, nice move up into the 886, and we get a rejection. I mean, it's typical 886 stuff as well. Very, very, very nice. To the downside though, we still have some more support, as you can see, which then actually brings me to the levels. So let me just zoom out. So here you can see some overall support and resistance levels on my chart. Here is the higher time frame volume levels. So these are all volume levels, which I very much enjoy. And these are the daily naked point of controls together with the higher time frame levels. Then we have the horizontal time frames. Time frame levels, so daily, weekly, monthly, if there are monthlies, but there aren't. First monthly is down here at 82, so there you go. And then we go to the news. So let me refresh the page here, as there's always some news. So here on Tuesday, September 16th, and on Wednesday, September 17th, there is some high impact news. Make sure you trade safe. Now what you can see here, the times, that's Central European time zone, so make sure to adjust it for your time zone. This website is free, I'm not affiliated, tradingeconomics.com/calendar. Really enjoy using it, so check it out. And this is here, the news. I guess Wednesday is going to be more interesting than Tuesday, but it can increase the volatility, so just make sure you trade safe. And then we have the probabilities. So on a weekly time frame, probabilities are highest for the bulls compared to the bears. This structure to the downside here, also higher probabilities. It is corrective, not motive, increasing probabilities to move up at a later stage. I always like to cover the weekly time frame because I notice some people get so involved on the 1 minute, 3 minute, 15-minute time frame, 1 hour time frame, and they long and short and this and that. But regularly you then forget the higher time frame directional bias and the structure that we're actually in. So that is why, I like to remind people of, hey, the weekly time frame, this is what it is. I cover it incredibly short, just boom, highest probability, still looking for a 5. But it just brings people back to, okay, this is where we are in the bigger scheme of things, even though you might trade on a 15-minute time frame, for example. On the 4-hour time frame, at the moment, the probabilities would be higher for a more sideways corrective structure. So the WXYs, and then depending on how high your X here goes, you're looking for a double zigzag, double 3, or a flat structure. It's just that for an impulse to the upside, you definitely still want to see a couple 4-5s. It's too early, in my opinion, to give this scenario here the highest probabilities, as I want to see this, right? I want to see a couple of 4-5s, couple of 1-2s. Once again, this range is a single wave 2. I mean, unless 2 is a triangle, which is not allowed, it's no bueno. And yeah, I mean, in the book, if you are gonna nitpick here, yes, in the book they do say that I think there was maybe one occasion where they spotted, the book being Elliott Wave Principle, where they spotted wave 2 being a triangle. However, they also mention right after in the book that a triangle for a wave 2 is a higher probability WXY with the triangle in wave Y, and not a single triangle. However, here we can't actually really get a WXY with a Y triangle. So it's just like, it's basically, you're strongly going against probabilities if you count a triangle in a 2, so it doesn't make sense. Then we have the 1 hour time frame. Probabilities highest to still take out this high at a later stage. Main resistance 118, 121. Main support 114, 111, 109. So that being said, I hope that this video was helpful or valuable to you. On the left you see a video on the simplest way to use and trade Elliott waves without even counting, and on the right is the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.